Thank you, Anand, and good afternoon, everybody. This is from my office in Federal Towers. I have my senior colleagues who are on the line, Ashutosh, Shalini, Venkat, Harsh, Anand, of course, and some of our other seniors. So between me and them, we will be able to give a glimpse of all that's going on in the bank and questions that you may have. But let me just start with a few opening remarks. You must have had a chance to see our Q4 outcomes. From a reported net profit number, certainly our highest ever, and importantly and gratifyingly, the commitments on ROA and ROE are trending to plan. And even more hearteningly, in Q4, we did take an accelerated one-off impact of the entire family pension provision of 140 crores in Q4, and yet could accomplish the number of delivering our ROA commitment, which has been driven largely by the asset quality of the bank holding out extremely well, and it's, as I've always said, years of effort to make sure that the credit quality of Federal Bank remains top notch, and thankfully it does continue to be so. So message one is we exit with reasonable momentum on the credit quality side, and we believe that will hold well as we go into FY23 and beyond. We have good insight into kind of performance both the restructured book is performing and our core book is performing, and we believe that despite the headwinds in the environment, we will continue to deliver good quality of credit performance. That is an encouraging sign. The second is for many years we've worked on building a high quality team, and I'm pleased that this year in particular the senior team and the team below them continues to be top tier, and I'm quite confident that the depth that we have for every position, we have two people waiting to nudge and take the next job. So I do believe team quality and team strength is good to deal with the challenges that FY23 may place for all of us in the market. The third message is that we enter FY23 well provisioned on books that we feel any kind of stress. We have addressed it robustly and importantly dealt with the having to take the strain of having to provide for pension. We've provided that upfront, so we upfronted that as well. The fourth, I think, what is going to distinguish quite materially in FY23 amongst banks, and particularly banks like us, is people who have a liability franchise that can withstand and deliver at times like this. All of us know interest rates are going up. There's going to be a war for deposits. There is going to be, to support the nascent credit pickup, you need a high quality liability franchise, and I've for long maintained that our liability franchise is amongst the most granular, most retail in the market, and I believe we think we have a good story going, and this year will probably show the fact that our liability franchise will hold better than many other banks and help us grow mid-teens in credit funded by our own non-bulk liability franchise. And the last, which supports the earlier point on deposits, is the fact that we've invested very materially in fintechs. I would like to believe we are the absolute go-to bank for the fintech partnerships, not just because it's glamorous, but because we have a model that works for both us and the fintech partners. And I'm quite committed and believe that FY23 will see that fan out in terms of both ability to grow and monetize these relationships. So we enter FY23 on the back of good credit quality, a team that is strong, an asset quality, well provisioned, an ability to grow liabilities, and meaningful, thoughtful fintech engagements that we are preparing for, and we believe that it will start distinguishing our bank quite substantially. These were some of the sort of entry opening remarks I wanted to make. The numbers are there for you to see, and we'll be more than happy to answer questions, any clarifications that are required. We had said that we will be on a trajectory to delivering 1.2 to 1.25% ROA by the 2 financial years out, which means in FY23 we are committed to being closer to 1.1 or thereabouts, slightly better. And at this point in time, our line of sight and our trajectory points to the fact that it's quite possible, and we are, barring any extraordinary external environment changes, we should be on course to delivering that. It's also happening that in FY22, our capital adequacy went up by about 100 basis points. We did have a new anchor investor who came in, and outside of that, our retained earnings and our overall performance helped us reshape the credit book, helped us raise our capital adequacy to 15.77, if I recall right. And lastly, but not any less important, has been this is the second year on a run we've been chosen as a great place to work, and this is relevant for a bank like us, which is traditionally seen as relatively an old world employer and don't have both talent and focus around these aspects. I do believe that we can proudly say that we're both great place to work and we attract good talent. So I'll just pause here and open it up for questions, and I'm sure between me, Ashutosh, Shalini, Harsh, Venkat, Ajit, Babu will be able to answer any questions that anybody may want to ask or clarify. Thank you very much.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Gaurav Kochar from Mirae Asset. Please go ahead.
Yeah, hi, good evening, team. My first question is on the OPEX front. I mean, we took a one-time hit of around 150 crore in this quarter. If I remove that, I'm assuming that this has come in the employee expense line. So if I remove that from the employee expense, it shows that the run rate is closer to 480-490 crore. Is that the way to look at it for the next year, the employee expense run rate of sub 500 crore?
Around 500 would be, within the, you should assume 500, 510, that zone, yes. Okay,
so around about 2,000 ballpark here,
yes.
100 crores here and there. Okay. And I remember, I mean, earlier you alluded to, in previous calls that FY23 onwards, some benefit of, some of the employees retiring, older employees retiring, that benefit would come in the form of lower pension liability. And also the yields are moving up. So is this 500 number net of all that?
Yeah, you could say that, yes.
Okay, sure, got it. Also, another point on the balance sheet front, I mean, if I look at the borrowings, they were up around 7,000 crores sequentially. I mean, our LCR is probably best in class. We have a very high LCR. I'm assuming the SLR component is also above the regulatory limits. Then why exactly was there a need to borrow? Is this some sort of NHB borrowing or lower cost borrowing that we did in the quarter end?
Yes, there was an opportunity to borrow 3-year money from NABARD, and that's what we did.
Okay, sure. Then that
which in hindsight turns out to be a good choice in the context of the rising rate. This is fixed, and so it's turned out well for us.
Yes. Yeah. And just that brings me to the question on growth. I mean, to deploy that excess borrowing or excess liquidity, what kind of growth are we looking at for fiscal year 23? Given that large banks are already growing 15% plus, any sort of growth outlook that you'd like to talk about?
May I step in?
Go ahead, Ashutosh.
Basically, if you see our CD issuance, CDs we allowed to mature and all. Number one, it brought longevity as far as the resources are concerned. It is refinance, and therefore exemption is available. CRR, SLR exemption is available. In retrospect, when we see CRR has gone up by 50 basis points, it looks like, that was a good call. Made in January 2022. So I think to answer your question, part of it was, replacement of CDs.
Sure.
From a credit growth point of view, we believe this year anything north of 15 is what we should be targeting. We are not, internally we have higher aspirations, but I think yes, 15 plus is something we are pushing for, and we believe it's very possible. Here the year went by, we were at about 10%. We did about close to 1.5% of securitization. So to that extent, we reduced our credit book by about 1,500 crores. So we did grow close to 12% last financial year. We believe this year it should be well north of 15.
Okay. Okay, sure. And on the repo rate hike, and given that our SA is also linked to repo rate, will the SA rate go up or the spread will be adjusted accordingly?
Spread will be adjusted. Large part, we have already increased SA by 15 basis points against a 40 basis point increase in. And we are yet, even after that, the lowest SA in the country. And growing at 19%.
Sure, sure.
Operator request has been initiated. If you'd like to cancel this request, please press *0 again.
Thank you. The next question is from the line of Maru Kadajania from Edelweiss. Please go ahead.
Hello, sir.
Hi.
Hi. So I had a couple of questions. Firstly, that you talked about mid-teen credit growth. This time round, it was 10%. So what gives you the confidence? Would it be inflation or market share gains, or how do we look at it?
It is a combination, Maruk. There are all businesses that are positioned for growth. Last year, because we went slow on gold loan for the first 9 months, we didn't go slow, the market also slowed. We saw lower traction. It picked up quite meaningfully in Q4, and I see that continuing in FY23. The previous year we had grown 70%, so this year it should be well north of 20-25%. Almost every business line has both potential opportunity and risk appetite to grow north of 15. There are some very nascent businesses like credit cards and commercial vehicles which may grow at an astronomical, maybe even hundreds of percent. But on balance, we believe that the 130,000 crores of credit book should grow north of 15% across the spectrum. There may be only one business where we may see lower than mid-teens, depending on the size and ticket and competition. We may choose to dial up, dial down on the corporate credit depending on the opportunities in the market. But otherwise, granular organic businesses all see huge potential to grow.
So a lot of banks, including PSUs, are complaining about very aggressive competition in well-rated SMEs and of course in well-rated corporates. So what are your thoughts there? Do you think with such peaking competition, is it possible to grow in these segments, or the aggressive guys are not in the segments you operate in?
No, I think the good segments are always fully flooded with good players, right? It's never going to be vacant for somebody else to steal. But I think the current interest rate environment and typically the rush to grow credit that a few banks were sort of gung-ho about, we do see, and I am quite sure you will see that behavioral change in a year like this. And that's why I said very early in the call that deposit franchise banks will grow better. Those who can garner good, low-quality, granular deposits. We believe that we have that tool in our hand, and we've demonstrated that for many years, and I believe that will help us grow. And yet, despite everything, growing at 15% in this environment looks very possible. I do have to add your point of a few banks cornering because of their sort of overall strength is indeed true, but I do think sanity in pricing is coming now.
Okay, sir, that's helpful. So my last question is if you could give the breakdown of loans by rates, so how much is MCLR, repo, and then fixed and other variables?
Very broadly, our repo book is about 45%. Venkat, am I right?
Yeah, Shyam, the external benchmark is 46, the MCLR is 18, and fixed is 27.
Yeah.
Okay, sir. Thank you so much.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal Securities. Please go ahead.
Yeah, hi sir. Congrats on a steady quarter. I have two questions. One is on margins. Like we have seen a 11 basis point decline this quarter. So any color on this, and how do you see this faring over FY23?
Nitin, I would request you to not look at a quarter, look at the longer period. 320 was the number we looked at, and we landed at 320. FY23, we believe that should shoot up by at least another 7-8 basis points. We think we'll blend FY23 will be closer to 325 plus.
Okay. And secondly, now that we have already absorbed the family pension cost this quarter, so how do you see the cost income ratio now?
We should normalize back to the early 50s, and as I've mentioned in earlier calls in prior period, we are pushing very hard to get it to below sub 50, closer to 48, but I think we'll need one extra financial year for that.
Sure, sir. Thanks so much.
Thank you. The next question is from the line of Rinish Goa from ICICI Securities. Please go ahead.
Yeah, hi sir. Congrats on a great set of numbers. So again, just might be in nature, but on the margin front, so despite our high lending books growing faster, let's say gold loan or a CVC of 40%, though I understand that base is very low, but incrementally if the growth in these segments are higher, why should margin fall in Q4? I mean sequentially. Is there anything which we are missing or any one-offs there?
Not missing anything, Ranish. If you see our slippages in Q4, there was a little exaggerated on the agri side, and that typically in an agri portfolio you will see a bunching up of interest, and when there's a slippage it tends to eat up a larger share of the revenue reversal. So to that extent that would have taken away 4-5 basis points.
Got it. Okay, that's very helpful. And sir, just on your opening remarks, you have said that the fintech partnerships have to some extent been matured now, and we'll see the P&L benefits start flowing in, from FY23 onwards. So any ballpark numbers you have in mind? Maybe it will flow through the other income or NII. I mean, where it should reflect in P&L?
No, it will be liability growth and asset growth. Both there is a dependency on this as a distribution, right? We've seen our Epify, Jupiter, and potentially a few more that are partners. They are largely a liability origination relationship. So we think about 25% of our incremental deposit growth will come from these partnerships, incrementally. Likewise, on the lending side, between 40 and 50% of the incremental lending in some products will come through these partnerships. These therefore will stack up for our growth in credit, growth in liabilities.
Got it. And sir, any cost benefit analysis we have done, let's say, whatever incremental business either on the liability side or on the asset side we get, we are getting at a higher than 50% cost to income or lower than 50% cost to income?
The revenue sharing and the cost model with the partners, as I mentioned in the previous calls and now is getting sharper, is a fair amount of it is variable. It's linked to the volume that is generated and it's not a fixed cost. In fact, 95% of relationship is variable. 1 or 2 there's some fixed element. And importantly, for FY23, for the incremental business, it will come at roughly at about 60% cost income ratio, trending towards 45% in the following financial year.
Okay. And FY22, I'm assuming more than 60-65?
Pardon me?
In FY22, the same would have been more than 60-65 cost to income?
FY22?
Yeah, current.
Yeah, roughly you could say. But FY22, both the pickup on revenue was latter part of this year. So on the incremental, it was about 65, but on the full year basis, it was closer to 70.
Got it, sir. Thank you so much, sir. Very helpful, sir.
Thank you. The next question is from the line of Kaushik Poddar from KB Capital Markets. Please go ahead.
Shyam, with whatever HDFC and HDFC Bank mergers being there, I mean, it's quite clear that banks need to get bigger to take care of the economy of scale. So is the Federal Bank, that is its board of directors, thinking in those terms?
Nothing at this point in time. Neither do we have opportunity to buy, nor has anybody approached us to be bought. So at this juncture, it's heavily organic with opportunities to look at integrating microfinance portfolios or any higher margin portfolio stroke companies, for which we have a marching order to go and find. Unfortunately, we haven't found any of size or scale, or if they are very good, then it's not an affordable price. But outside of that, nothing, Kaushik. We don't have any, at this point in time, dialogue with anybody one way or the other.
Okay. Okay. And basically, you're talking of purchase of financial asset. I mean, in the sense of some
asset,
portfolio.
or if a sort of a well-run microfinance setup is available, we will be happy to consider a transaction. But I have to add quickly that nothing is in the cards.
Okay. Okay. And this cost, I just wanted to confirm, cost ratio for this year, you are putting it at 50%?
In FY23, yes, we're looking at 50-51%.
50-51%. Okay. 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 Thank you. Thank you.
Thanks.
Thank you. The next question is from the line of Manish Dariwala from Fiducia Capital. Please go ahead.
Yeah, very good afternoon.
Hi.
Now, see, my whole question is surrounding the question that's been asked about the growth. Like this particular quarter, our yield reduced and the cost increased. And this quarter, the NIM was also quite at the lower end, say about just 3.16, and you're saying that the other year is 3.2. So basically, see, the environment is going to be remaining challenging. And now, already the provisions are down to 75 crores. So I don't know whether they can come even further down. So where is it that we're going to get the PAT from?
I think, I did mention a little while earlier, our NIM expansion to 325, 327 is something that by the business mix change and the prevailing rate environment looks very possible, and it will happen. The cost this quarter was a little exaggerated because of the one-off event. So we do believe that there will be a positive jaws, as in the revenue will outstrip the cost growth, and credit quality will continue to hold as well as it does. So that's how we are expecting a 10 basis point improvement in our margin expansion, ROA expansion.
Yeah. So see, we are today at a very, very solid platform in terms of our asset book, the quality of our asset book. And, don't you think that we should be kind of using that to step up on our growth aspirations?
I did mention we will grow very handsomely, but as a conventional...
15% is something that like organizing would...
No, I respect your observation, but there have been stories of people doing 30-40% growth and then going to jail. We have no such aspirations. I am also acutely aware there are some banks at the scale of an HDFC growing at 20%, but we will be honest and real about where we can do business and how we should do business. So you will not hear Federal Bank trying to talk itself into a position which then looks ugly a few years later. Will we seek out 20%? Absolutely, yes, we will. We will. I mean, we are not any less ambitious about growth. But I think we have to be quite honest about the way we do business. If you heard us or tracked us for as long as I've been, we've never made false commitments. We don't intend to also.
I mean, that's a good sign. That's a good sign. And also, see, we've been really kind of developing our fintech side of the book. So far, the costs actually have gone up despite the fact that, our branch expansion has not happened. We basically say that, a lot of our business is going to come from the fintech relationships. So this year, FY23, you think is going to be the year of inflection where the money is going to flow in, the monetization is going to happen?
Yeah, I did mention just a few minutes ago that we will see a meaningful part of our incremental growth coming through these partnerships, and it trending towards the 60% cost income, and the following year towards the 45% cost income, or even better. We look at this the following way. For about 5 years plus, we've added 20 branches, but we've doubled the bank in almost every dimension. And we are now, these branches, in fact, I'm very happy to report at this point in time, we just reported to our board today, we have only one branch that is non-profitable, and that too only because it's less than 2.5 years old. So we have every branch in the bank at good efficiency and productive and going ahead. So we have told ourselves two things. One is we will dial up our fintech partnerships, which is typically if you open a branch, it takes about 18 months or so to break even. Our fintech partnerships will break even faster. So when we grow 25% in incremental deposits. It's almost like adding 300 branches. Right, one. Second is, in addition, for a distribution, our strategy was branch-light distribution heavy. We have flipped it around to light branch heavy distribution, which means we will start adding branches. Maximum about 5% of our network will increase every year, and that again will start giving us distribution. So both counts we are doing work this year and beyond.
Wonderful, wonderful. Thank you for this detailed reply. We really look forward to increased numbers. Thank you.
Thank you. Thank you very much.
Thank you. The next question is from the line of Sagar Shah from Alpha Line Wealth Advisors. Please go ahead.
Hello, sir.
Hi.
Yeah, hi. So actually, I just had one question actually. So basically, based on the past performance of your agri-banking portfolio, your NPAs seem to be highest in that front actually. And in spite of that, in this quarter, your agri portfolio, you have grown by 20%. So do you feel that going ahead, this portfolio would see some improved asset quality, or we'll see the same growth rate going ahead also?
This agri must remind us that it has got gold on it. Huh? So when it see 20% growth, it includes the agri gold loan also.
Okay.
And the point about agri portfolio facing higher losses is new to me. Maybe I'm not fully informed. I didn't realize it that way. In this quarter, there was a one-off transaction, higher than normal. This quarter was 140 odd crores. Normally, it's never been that high. It includes agri, and in the past, it used to be agri and SME. So in a reporting sense, if you look back in time, it was agri and SME integrated. But now we've partitioned that. So if you look at it, I don't recall ever agri being a big problem, except for this quarter where we took a larger hit of 89 crores one transaction.
If I may add, this is because of, I think basically you have special dispensation for agri. You have two crop sort of, permissibility, wherein, if after one crop season, if it is not paid, the account is not classified NPA for another crop season also. I mean, these are some peculiarities with agri loans. Therefore, there is a after effect of COVID, which got materialized here with delay. In other segments, it happened, then and there. So you
expect this. So you expect this portfolio to do well in FY23 also,
yes,
right?
Yes, in FY23 we will not have that legacy, COVID legacy, affecting the agri portfolio or so. So there is this is something which is peculiar to agriculture, and therefore even interest reversal, because you are maintaining that account as standard for say 2 crop seasons, so the accrued interest also needs to be realized interest also needs to be reversed, and that has impacted the NII also. Somebody had asked this question about NIM. So partly this NIM contraction by 3-4 basis points is an outcome of that, agri slippages also. I hope that clarifies.
Yeah, certainly. And my last question was related to your business banking and commercial banking portfolio. So basically, your commercial banking portfolio, I think so you have been growing at almost 8% in the last 5 years, 8% CAGR. So as you said in your last comments, on an average, you will be growing around 15% on almost all the segments. So are you confident, in spite of such heavy competition in the business banking and the commercial banking segments actually throughout the banking system, so are you still confident of delivering 15% growth in both the segments?
I think we are well positioned, Chief. In the Q4, these are two businesses that grew, I think, for the quarter 4%.
Yeah.
In the most intense competition period.
Yeah, absolutely.
We remain confident on that.
Okay, sure. Thank you, sir.
Thank you. The next question is from the line of Krishnan ASV from HDFC Securities. Please go ahead.
Yeah, so just one very quick query around deposit side. This was more to do with the fact that you mentioned about the fact that branches, except for one, have kind of broken even. I was looking at more at the productivity of these branches. Have you seen a marked improvement in the potential in productivity of Federal Bank your branches compared to peers, and what are you doing to build that potential?
I think firstly, for quite a while now, and each passing year it gets better, the sharp focus on products that we want our branches to be doing, and branches, how much of their time is spent on sales, service and operations. So we've carved that out quite nicely. The reward mechanism for branches are driven by what their job objectives are in terms of productivity. You may have noticed our fee income ex treasury has grown 25% Y on Y, 10% sequentially. Largely fee income on wealth management and life insurance are branch led and has done a remarkable job. So productivity on business banking, gold, collections where they need to step in, and fee income products in addition to CASA growth is their job. And on all counts, there's very, very meaningful progress. And each year they are being triggered to perform even better. Their scorecards are sharply focused on this.
Absolutely. Yeah, for you, me, Chechi,
listen guys, somebody need to mute yourself. Go ahead, Krishna. Anything else?
Yeah, the other bit was around just, the growth environment itself. Generally, we have remained fairly conservative even when other peers are able to sequentially grow faster. You have been very picky because you are quite selective. I just wanted to understand, do you see from say a pricing in perspective any competitive intensity easing in any of the key segments that you're definitely looking to grow in?
I don't see it easing, but I think there is some sanity coming in this very aggressive pricing that was happening in Q3, Q4 of last financial year. Of course, April is usually a bad month to make any determination because there's a slowdown of varying nature. But given trends, conversations and the general interest rate environment, we believe that some pricing power will come back to lenders. And within the same risk appetite framework that we have, we believe our growth numbers that we spoke about, 15% plus, is very possible, without busting our boundary conditions on lending.
Right. Just one last query. You've built a fairly granular book on the asset side of the balance sheet as well. It's very carefully crafted for the last few years. Just wanted to understand what kind of wallet share, your assessment of where you are on wallet share and where can Federal Bank potentially take this over the next maybe 2-3 years.
Did you mean product per customer? Is that what your question is?
Not necessarily on just the individual side, but even on the commercial banking, business banking side, the SMEs that are typically where you can still exercise some element of, say, the pricing power.
See, as a thumb rule, I want to say that good customers, irrespective of which segment they believe, are able to command pricing. Right? Then it comes to the relationship potential and our frontline guys' ability to work with them and get more business. As we get more RM and outward client focus, as in we go to the client as opposed to client comes to us, we are seeing that capability drill deeper and get a larger share of the wallet. In small business, business banking, commercial banking, I think our share of business is increasing with every passing. Kapil, Ratesh, Shalini, Harsh are on the call. They may also add, but that's increasing. On the corporate, where it's only a big ticket lending, that's a fight. But even there, we've seen very sharp growth in fee income this year, and driven by these initiatives. But I think there's work to do on that count.
Just to add, Harsh here, on the commercial banking, business banking side, we are typically in most cases sole bankers or a dominant banker, and other ancillary businesses follow suit. In the mid corporate segment, the large corporate, obviously we are gaining share. To give an indication, our trade volumes, our cash management, and the fee growth has been significantly higher than our asset growth, obviously indicating gaining market share over there as well.
This is helpful.
Wallet share. Yeah.
This is helpful. Yeah, sure. Many thanks, Harsh. Many thanks.
Yeah. Thank you.
Thank you. The next question is from the line of Kashyap Javeri from MK Investment Managers. Please go ahead.
Thank you so much, sir, for this opportunity, and congratulations for good set of numbers in challenging times. Just two questions from my side. One, if I look at fees, there is this, general commissions which have grown almost, 50% Y&Y from about 45 crores to 70 crores. Last 4 quarters run rate has been about 45 crores. So, what has driven that number, and which seemingly is the primary driver besides cards of 25% growth in fees. And second question is on CASA. Now, if I look at last 3 quarters, the SAR number is now pretty much at about 51 to about 54,000 crores. And CA number is also pretty much stagnant at about 12,000 crores. So, any color on the client acquisition on both the sides, both CA and if you can offer? Because what I understand is that with the the fintech partnerships that we had, the number of client acquisition has gone up substantially, but that's not pretty much probably reflecting in the overall float available. So these are the two questions.
Sure. I think on the SA, we can't expect the fintech to give us in the first period. In fact, at this point in time, incremental growth, fintech, business origination in SA would be like, less than 5%, which is what we said. It will go up to 25% in FY23 of the incremental balances that get built out. And because the profile of these customers come in and they're more transaction and they start building over a period of time, I don't believe that they will all be coming with large balances upfront, because the nature and profile of that base is very different, right? And that will continue, but it's giving us access to a new generation of clients which we would not have hitherto banked, and therefore the ability to cross-sell a bunch of products kicks in, and that's something that we're working on. That's why I said 25% of our deposit growth incremental and around 50% of our incremental credit growth for some products will come through this segment. Sorry, I missed the earlier part of the question. If you want to remind me.
So second question was on fees. So the banking commission and exchanges run rate was about 45 crores a quarter, and suddenly this quarter it's almost about 70 crores.
So I think the growth on our fee income products like life insurance, mutual funds have all picked up at, doing extremely well, and that's all branch led. And I think when Krishnan asked, I did answer that in terms of these products are branch distribution led, which is doing very well. Penetration into existing client base is increasing. Shalini, you want to come in on that and give your insights on that, Shalini?
Yeah, thanks, Shyam. So I think there are a couple of drivers for driving up the fee income, taking off from where Shyam left. One is on the card side. While credit cards is still a very small percentage of the portfolio, on debit cards we've been kind of very good from a spend perspective, and we rank amongst the private sector banks probably fifth in terms of monthly spend. That has its own benefit in terms of interchange fees. So that's one part of the fee income. The other part of the fee income that is growing at a very steady pace is the entire suite of products that we offer under parabanking, which is life insurance, non-life insurance, health insurance, wealth management, and products like depository, DMAT, sovereign gold bonds, etc. That's grown 10% Q on Q, 25% year on year. So combination of these kind of factors, along with normal, debit, the ATM fees that we get, etc., has helped us to grow our fee income. Very much driven by customer behavior, very much driven by the use of analytics to cross-sell products to the customer, and very much driven by branch productivity.
Sure. And one last question, would you be able to disclose monthly client acquisition on the liability side?
Roughly in a day we do, between our organic plus the two partners, we are doing closer to 17 to 18,000 new customers.
Okay, sure. Thank you so much.
Welcome.
Thank you. The next question is from the line of Shalini Vasanta from DSP Mutual Fund. Please go ahead.
Hi, good evening. This is Vivek Ramakrishnan. My question was the deposit side. This year seems to be the year where there will be a bit of a scramble for deposits, and since you are using fintech and everybody else is also going to be using similar fintech, what causes the stickiness in your deposit base, and how confident are you that you can grow it in the scramble for deposits? I'll also ask the second question so that I can do it sequentially. In terms of, you have a NBFC that is doing small finance business and it's doing quite well. So how important is FedFina to your overall targets of ROE and growth aspirations? Thank you.
FedFina, every number of that other than the consolidated number is an independent entity, chief. We have none of that including, except for some retail distribution they do for home loans. Other than that, they are an entirely independent entity run by their board. Just the consolidated numbers is what you see in our numbers, but that's a very marginal number in the scheme of things for us as of now. But they're doing well. I'm happy they're doing well and they should do well. For the first part of your question, stickiness, I think for a long period, that has been the strength of our bank. I mean, the remittance business that comes in, Middle East Kerala, Middle East non-Kerala, non-Kerala, non-Middle East, all of that are tracking well. Domestic franchise across the country, our non-Kerala deposit growth is higher than our deposit growth in Kerala, driven by A, a lower base, B, a higher presence and productivity. Third, as we step up and see more fintech engagement and this client base starts maturing, we believe there will be an incremental opportunity, but that is to be yet proven and tested. Why would we grow and why would customers stick with us? With some confidence, I can tell you, if you are a Federal Bank customer, rarely do you leave us. Our NPS, and this is not by my measure, NPS scores as measured by Nielsen for the industry, we rank amongst the top 2-3 NPS scores. Now, for common understanding, Net Promoter Score is the best measure of customer referencing us or promoting our case and sticking with us.
Thank you, and all the best.
Thank you.
Thank you. The next question is from the line of Mahesh MB from Kotak Securities. Please go ahead.
Okay, hi. Good evening. So a couple of questions. One is on this on slide 23 on the retail book. Shyam, this growth that you saw in housing seems to be very weak. It's down on a QOQ basis. Anything?
Mahesh, I think we have got the numbers slightly wrong on that slide. We will update that slide and we'll probably update the presentation.
Okay, perfect. On the second question, you had kind of indicated this breakup between MCLR repo. That number adds to 90, not 100. So you said 45 repo, 18 MCLR, 27 fixed.
The rest of them are like staff loans and FX and a few other small 1%, 2%. So I gave you the bigger one.
Okay, perfect. And one last question is that on the pension related cost, how much was it for the full year that you had provided out here?
185 crores on the family pension.
No. If I include the entire provisions that you made, if I look at
it would be north of 350, 400 crores.
A comparable number, this would be 500 crores last year, if you just kind of look at the annual report and kind of compare it with the number that you have given?
Let me not try to guess that. Venkat can or he can give.
Need to check that out. Previous year. Around 440 to 450, Mahesh.
That is last year or this year?
Last year.
And this year the number is 350?
No, this year if you add the family pension, it will be higher.
Pension alone is 185. Yeah.
Okay, sorry.
I'll have to look into what is it current year. I haven't checked that.
Okay, perfect. Thanks a lot.
Thank you. The next question is from the line of Rishabh Inderkar from Guardian Capital. Please go ahead.
Hi, good evening to the management. I just had a couple of questions. First, could you take me through what reason for a decline in treasury profitability?
Ashutosh, you want to come in?
Yeah. So I think basically when interest rates start moving up, you do not have the opportunity to really make profits on bonds. Yeah, through shorting, some part of it has been compensated and through some forex volatility was there, but that trading gain cannot substitute the the investment related, opportunities, profit on sale of which is classified under profit on sale of investments. So I think when you see yields going up, the risk is on the other side that you are required to provide for it rather than, earning profits there. So we had been maintaining very low PVBP or very low modified duration in our HFT and AFS portfolio. As a result of that, the hit is minimal. But at the same time, the opportunity to, make profit reduces that much. But if you see for the year as a whole, first quarter had been very, very good. So when you compare year versus year, I think you would find this year to be quite okay. I mean, the year that has gone past has been quite okay on that front. FY23 may have challenge.
Okay. So any guidance on what sort of profitability we are looking at in treasury business next year?
So on the forex side, there would be a normal growth of 15-20%. But on the investment side and all, there are some opportunities, but that would depend on what call we take, depending upon the then prevailing scenarios and all. Investments in some of those, strategic investments and all. So that's something, which we would decide in the fourth quarter. Overall, I think, profit on sale of investment has not been as such, budgeted at the same level that which it was. The actuals have come for FY22, but that would be compensated through the core growth of core fee income growth, which has trended very well in third and fourth quarters of the previous year, FY22. So in FY23, we can take it forward to compensate, and that's going to be more sustaining.
Got it. Okay. And the second one being, do we have a breakup of, the fixed rate, in terms of loan book, do we have a breakup of fixed rate and floating rate loan?
That's what CFO had given, Venkat, you can repeat that. I think it's fixed rate is 27%.
Yeah. 27, 18 is MCLR, and external benchmark is 46, 47%. Yeah.
Rest is, advances against specified securities, NFCs, shares, your bank's own deposits and all that. Which
foreign currency also, Ashutosh.
Huh?
Foreign currency also.
Foreign currency, base rate, a few small, 1%, 1.5% like that. Yeah.
Got it. And earlier during the call, it was mentioned that from FY23, we would start monetizing the fintech relationships. Do we have what is the model that we are using for monetizing these?
No, I think when I said monetizing, it means that the investments made start fetching revenues. And I said this year, broadly the cost income should be closer to 60%.
Oh,
so
okay.
For every rupee we spend, we expect at least 60 paisa of revenues or more is what we're pushing for.
Okay, perfect. Okay, thank you.
Thank you. Before we take the next question, a reminder to the participants, please limit your questions to 2 questions per participant. For any follow-up, may we request you to rejoin the queue. The next question.
My apologies. For every 61 rupee we spend, we earn more, not 60 paisa. We earn more than that. So 1.5 or whatever. 1.5. Sorry, apologies. Yeah, go ahead, please.
Thank you. The next question is from the line of Franklin M. from Equitas Wealth Advisory. Please go ahead.
Yeah, thanks for taking my question. So just on the deposit trajectory last 2-3 quarters, we have seen a slowing trajectory in the overall deposits, and we are likely to grow our advances by 15% plus in the next year, which means that our deposit base also needs to start picking up. So one is like, what is the reason why the trajectory has slowed, and how is this trajectory likely to pick up?
So I think this question had come earlier. I think part of the deposits is your certificate of deposits and all those. So we have reduced our so-called bulk and wholesale segment. In fact, part of it has been substituted by the refinances from the refinancing, institutions like NABARD and all. But that doesn't come under deposit, that comes under borrowings. Though it is longer term, very competitively priced and all that. So the thing is, I think you may see a reduction in total deposits or rather slower growth in total deposits. But if you remove this, conscious substitution and all, the deposit growth is matching the advances growth, loans growth. Retail deposit growth is in double digit.
Okay. And on the NIM trajectory, you said that around 3.25 is where you are looking to maintain the NIMs for the next year. But is there scope for further improvement, like the year after that, or is this 3.25 likely to be more of a sustainable number?
No, I think the effort of the bank as the mix of the business changes, and in a rising rate environment, certainly to go higher than the 325, closer to 330 or beyond. But I think these are best delivered and then spoken of the next milestone.
Yeah, thanks a lot.
Yeah.
Thank you. The next question is from the line of Gaurav Jani from Prabhudas Lilladher. Please go ahead.
Thanks for taking my question. Firstly, question to Shyam sir. Sir, so on the CASA ratio, we're at about close to 37. In the coming year, as we're glaring at a higher interest rate environments, generally for us and for the system, how do customers behave? So could we retain these customers, or should we logically see a reduction in the CASA ratio?
No, we are looking at in CASA we have to look at two things when you look at a ratio of both the numerator and the denominator. What we are aspiring and working on is to get the CASA growing at the north of 18% growth rate. And term is a function of both pricing and demand that we want. So CASA ratio can swing, but preferably we want to push it by another 100 basis points. In the last 2 financial years, we moved up 313 basis points in CASA. We believe that we should get it closer to 39, but we are working on that. Over a period of time it will happen. But more than the ratio, please focus on the net blended cost of funds and CASA growing. Having said that, the ratio will improve because that's also a focus area of the bank.
Yeah.
Our cost of money is now in the top quartile, 4.3 or whatever that is.
That helps. The second question is to Shalini ma'am. On the credit cards front, ma'am. So firstly, wanted your views on the new credit card guidelines, and considering we had tie-ups with fintechs for co-branded cards. So how would that sort of shape up in terms of growth?
Sure. Thanks for that. I think two parts to it. One, insofar as our organic credit card portfolio is concerned, which is our own portfolio, which is growing at a good rate. From the directions, there are a range of items which RBI has introduced in the new directions, primarily driven by the need for transparency from a customer standpoint, making it easier for customers, making it more convenient for customers. Examples being, you can change your billing cycle. You need to, if it's not been activated within 30 days, it needs an OTP to do it, etc., etc. So there are maybe about 10 or so items which are primarily operationally required to be delivered on, none of which we find challenging from a delivery perspective. Yes, it will potentially increase a little bit of the cost of the processing, but in the overall interest of customer stickiness and growing balances and getting the credit card as a trusted instrument, I think that's a good balance to strike. So that's on the organic one. Insofar as the co-branded one is concerned, we have a partnership with SPL, and that's a partnership that has been live for about probably about 8 or 9 months now. From our standpoint, SPL currently plays the role of both. It's a promoting and acquiring cards for us as a brand partner for us, as a co-brand partner, but the entity also plays a role as an outsourced TSP or technology service provider. Under that role, SPL ensures an end-to-end customer experience, mobile-first kind of customer experience. The master direction has made certain areas a little more explicit in terms of what can be done, not done, etc., with the co-brand side of it as well as the TSP side of it. We don't believe any of them are showstoppers of any kind, but we do believe that we will be able to deliver on those with our partners. So we're quite, as we stand right now, with a couple of months more left for the implementation date, we're quite confident that the trajectory will continue. So both ends, we've had a fairly detailed look at it, and we do believe that it is in the general health of the industry. I think both are good. The measures are good, and we can deliver on them. Yeah.
Ma'am, just one question on the credit card growth bit. So, considering we are looking at, again, rising interest rate environment, should we sort of assume that we have to sort of, slow down our growth, or how should we look at growth? Obviously, we're on a low base, but I mean...
we have a low base. We are exactly what you say. We have a low base, and also the overall credit card penetration in the country, all of us know, is still very, very small, right? So I personally don't think we will see any material slowdown in the credit card growth because the penetration is so low in the industry as a whole. And for us, the base is anyway so small that we have an opportunity to grow. What could potentially get impacted is within that we obviously look at revolvers as well as revolvers on the outstanding as well as those using balance, transferring the balance to an EMI. That may see a little bit of a reduction, but honestly, for us at least, the portfolio being small, we'll still see a growth there.
I'll just add what Shalini said, Gaurav. In the only product which is reasonably rate agnostic is credit cards. So a rising rate doesn't necessarily mean because they're already at 24, 25, if the revolving guy is already paying that rate.
Sure. That helps. Thank you. Just final one, if I can squeeze in. One is what percentage of our liabilities would sort of mature within 1 year, and the update on the FedFina listing, please. Thanks.
FedFina listing, I have nothing to add than what I had said. SEBI is yet to come up with the approval, and then post that, the company has up to a year to list, so there is no timeline date for it. On liability, what was the question? The profile that is maturing?
Yes. What proportion of the liabilities would mature, say, by FY23, within a year from now?
That's in the fixed deposit portfolio, right? Ashutosh or Venkat, anything that you can share off the top of your head?
Sorry, please. What's the query?
FD book.
From an ALM standpoint, what proportion of the liabilities would mature within 1 year?
So I think on the term deposit side, nearly 60 to 65% of term deposits have the original maturity of 1 year.
Yeah.
So nearly two-thirds of the term deposits have the original maturity of 1 year. So remaining maturity could be few days to 12 months.
Okay. Got it. Thanks.
Thank you. The next question is from the line of Anand Dama from MK Global. Please go ahead.
Thank you, sir, for the opportunity. Sir, the housing book and the PL book both have declined on a quarter-on-quarter basis. Is there any reclassification which has happened?
I think Anand mentioned there's an error in reporting there, Chief. Sorry, that needs to be corrected.
Yeah, but on the personal loan side, I think there last quarter also we had said that basically...
Personal loans has declined. Rate of growth has slowed down because we did not grow that business aggressively in FY22 for the purpose of credit quality and comfort that we get. We see that happening going into FY23.
But Shyam, basically when we look at other banks, be it HDFC, ICICI and all, they are all growing into the personal loan segment which they believe is largely mainly focused on the captive customers. So what really makes us so concerned about that book?
Anand, I think the question on why they are growing or why we are not growing, we can only answer why we did not push that hard, for the very reason that we tightened our criteria for existing customers. We do only pre-approved digitally originated personal loans, which was growing at about 100 crores a month pre-COVID. During COVID, we tightened the criteria quite materially. So the book started running down. The backfilling of the book is now running at about 60 crores a month. As we go into, we are now getting more comfortable with the environment, so we are unleashing some of the parameters back. So growth will come back.
Okay. And so when we said that we are looking to grow at somewhere about 15% or so, I mean, even at the top end, about 20 odd percent. So how will the retail look like, and how will basically corporate shape up?
Businesses like credit card, personal loans will grow well. I mean, credit card will grow, well about 100% or even more, because the base is small. Personal loans, which is close to about 2,000 crore book, will grow at about 18% to 20% this year.
Okay. And how about mortgages? Because that book also, in fact, if you look at the other bank, they have been growing at a much faster pace.
Just on the previous question, roughly 40% of the liabilities mature in next 1 year. Just wanted to make that point here.
Sorry,
I have the question on mortgages front. So why are so the
that 40% is natural, Venkat, because you remove nearly 40% of CASA, the remaining one, if you take 60% of that, I mean, say almost 2/3 of remaining 60% comes to 40%. So that's same number remains the same.
Okay.
Shyam, the question was on mortgages. So what kind of growth rate are we looking at in that segment?
This year grew close to 14%. We think that will grow it back to the previous year grew about 18%. We think that will happen.
And on the corporate front?
Corporate business, I mentioned a while ago, we grew this year more at the back end. We started growing. We believe this coming financial year we should grow well into the early teens, but I would be cautious about the opportunity in terms of pricing. So we will pick that. We'll be picky and choosy. Last year we sanctioned but did not disburse 3,000 crores of corporate credit.
Okay.
If we had disbursed it, we would have had another 3% growth, but we chose not to. Harsh, am I right? Harsh?
That's right, we are right, Shyam. We had done that, and apart from that, we had done some sell down of assets, which is another 2.5% of the corporate portfolio.
Okay. Which means that the portfolio mix is going to shift more towards retail and I think SME. In that case, we should see a margin uptick.
Yeah, I mean, we said 55-45 retail wholesale. Within retail, we will have a higher mix of higher margin businesses. Likewise, in wholesale, the commercial banking will pick up. We also said the portfolio NIM will move up to 325 or so. So we must add that 10 basis point from 316, 9 basis point increase on a whole portfolio of 130,000 crores is a lot of heavy lifting to do.
Okay. Thanks, Shyam.
Welcome.
Thank you. The next question is from the line of Darpin Shah from Haitong Securities. Please go ahead.
Yeah, thanks. All my questions have been answered.
I think, operator, we should bring this to a close if there are no other major questions.
We have few participants in the queue, sir. If you allow me, I can promote them.
Sure, please go ahead.
Thank you.
Maybe we can pause here. Whatever is in the queue, we can close out.
Sure. The next question is from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. On your exit ROA, sir, so adjusting for this family pension, we would have done 1.24, 1.25, which was we had said earlier. If you can refresh this exit guidance on exit basis or maybe full year basis for the next 1-2 years.
We had said a 1.25 2 financial years out, and we are still holding to that. We think FY23 will be closer to 1.1 to 1.12, 1.13.
Sorry, so for full year basis, right?
Exit ROA, full year will be about 1.07, 1.08. 5 basis points more from the exit just now.
Sure. And sir, within which credit cost, if I see for this year, what you have reported is 45 basis point. Do you see any more scope to lower it, or this should be, more?
This will be reasonably optimum at this point in time, 45 or so. Yeah, I don't see. I mean, we are working to an improvement on that, but let me be honest, we will pad up a little in case things work in favor of us.
Right. And the last two questions are on restructuring. So how much of the performance looks decent, and I think you have also mentioned 95% collections. But just wanted to check, are the entire book out of moratorium, and maybe how many customers are paying in full, etc. If you can share some details.
Our head of collections has done a PhD in it. So Babu, if you're there, you can just quickly give a 1-minute answer to this.
Yeah, it's right now the restructured book is primarily to say quality book as in the case of our normal asset book. That's why this better collection is happening and the slippage rate has also come down. 40% of the book is already there coming in the demand book in March, and there we are doing well. So looking forward also we are confident that we'll be able to close somewhere on those lines only. In terms of exact number of customers, right now I don't have that number with me, but for 40% of the entire book has come in the demand book in March, and there we have done well with the support of the quality of our book as well as collection of.
So sorry, actually I could not hear much, but did you say that 40% of the book has started billing, right?
See, there was moratorium. So once that moratorium is over,
You're right. 40% has started billing. That's what is the demand book. Yes.
50% of the book has demand in it, and there it has performed quite well.
Yeah. Right. And the same thing, sir, for ECLGS. If you can share what is the outstanding and how are you seeing trends there? Yeah, that's it.
Their ECL book is also doing well, perhaps better than that of the last quarter. ECL book right now it is 4,300. Where our maybe slippage rate is far below the average slippage rate of the bank. There quarter by quarter it is doing well.
Right. So what is the amount, sir? 3,000 crore or something else?
4,300.
43, right? 4,300.
Yeah.
So that is actually, if I look at my numbers, it looks like it has increased from last quarter. Is that right?
Yeah. A little more disbursements are also there from GECL. They've been extended regulatory direction was there, so something more was dispersed. Including that, it is 4,300.
Understood, sir. Yeah. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Dhaval Gala from Aditya Birla Sun Life. Please go ahead.
Yeah, thank you, sir, for the opportunity. I think you already answered partly on net interest margin. Just wanted to understand a bit of a outlook on your net interest margins for, say, next 12 months and medium term.
No, I think you heard right. We are talking of going up from where we are for Q4 or average basis 325 FY22 by moving by 5 to 7 basis points in FY23 on an average basis.
Okay. You mentioned about that F23 we could see monetization from a lot of your fintech partnerships. If you could elaborate when and what should we look at, what line item would we see the monetization?
No, I think it's not a line item. If the incremental cost income on this portfolio, we are looking at for every 1 rupee spent, we should earn 1.5 rupees.
Okay.
I mean, we're looking at higher, but that's the minimum what we will push for.
Or it would be part of both margins as well as fee?
It will see if they're building deposits, it will come into the interest income portfolio. And on the credit card, it will be largely fee income. Actually mixed, it will be credit income and interest income.
Sure, sir.
Thank you. The next question is from the line of Prashant Kumar from Sunidhi Securities. Please go ahead.
Thanks for the opportunity, sir. Just on quick on one data point. On asset quality side, if I calculate back calculation, the addition for FY22 is roughly around 1,840 crore, and reduction is on my calculation 2,346 crore, and write-off is around 800. I need breakup of upgrade and recovery if it is handy.
It's there in the deck itself, Chief. All our numbers are there in the deck. By quarter you will find it.
Yes, sir. Just upgrade and recovery, if bifurcation, if I can get it.
You mean the split up between upgrade and recovery?
Yes.
How would you have it at the top of your head?
Yeah, sir, this 800 is excluding this 800. there was a sale of 7G, the sale of 7G, a pool of mortgage batch.
No. He's talking of full year. Full year number he's talking of.
Yeah, I'm telling about the full year. Let me check. I'll get that.
Maybe you can put that as a number in the deck so that everybody will have access to it. You can put it in the deck. In slide 7, we'll update it.
Sir, apparently I do have the total number. 1258 is upgrade and recovery. And then maybe ARC total full year is 275 and 800 is maybe write-off. TWA.
Sorry, again, please repeat. Only upgrade.
1257. Recovery and upgradation full. That is more than that of the last financial year, or maybe for recent years. This is the highest.
Babu, they are asking about the breakup of recovery and upgrade. How much is cash recovery? How much is upgrade?
666 is the recovery. 591 is upgradation.
Yeah. Now the number is breakup is given.
Yeah.
Thank you so much.
And 591.
Yeah.
Thank you.
Okay, fine. I think, operator, we should bring it to a close, please.
Sure. I now hand the conference over to Mr. Anand Chugh for closing comments. Over to you, sir.
Yeah. Thank you so much, everyone, for being on the call and participating quite actively. We'll connect back with you probably next quarter. Thank you so much.
Thanks, everybody.
Thank you. Ladies and gentlemen, on behalf of the Federal Bank Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.